timing the markets, as you said, is impossible. I think also in terms of this correction in U.S. tech and China, we need to put this in the perspective of, Nasdaq is down 11% off its all-time highs. CSI 300 is down 14% off all-time highs. So there is a little bit of a correction going on, but given the moves that we've seen over the last year and over the last couple of years, it's not really unexpected to see a little bit of a pullback here. But for us, the messaging hasn't really changed in terms of looking for quality. We continue to advocate increasing exposure to China, both on the equity and the fixed income side. So I think, with this correction that's happening now in China, I don't think it's a huge surprise given that the economic data has been very strong, and now we're starting to see a rotation into some of the laggards. I don't think that's a huge surprise, but I think in a longer term, we're still looking for clients to increase weightings towards China.
In the short to medium term, though, just putting aside the longer term horizon aside for 2 seconds, is it possible that the tailwind that we've enjoyed of the vaccination rollout around the world will start to become a headwind? Because as we draw to a close on that vaccination rollout, perhaps people are going to start saying, okay, well, emergency settings at the fiscal and monetary side just aren't necessary anymore. We're going to start to see a removal of that accommodation.
Exactly, and that was rather anti-consensus a few months ago. That's becoming a lot more consensus now, especially with the backup in terms of the 10-year in the U.S. And we were talking about this all throughout last year, right? This was not a fundamental valuation or earnings-driven rally. This was purely liquidity-driven. So what happens when investors start to worry that the taps are going to get turned off or at least softened a little bit? And what would that come from? And that comes from a return to economic normalcy. So there is a balancing act going on at the moment. We still believe that central banks can get it right, but that is certainly still a concern that when liquidity falls back, that we could get a further correction.
Okay, and we are in the midst of that. Thomas, good morning. Thank you for joining in this conversation. Given what's happening in Greater China, right, the CSI 300 in correction territory, the Shanghai Composite under pressure, how do you see the gap between the A shares and the S shares market evolving?
Yeah, so I think when we look at A versus H, we do like both. I think at the moment there's a lot more pressure happening in the H shares, given that it is more technology driven. And so when you start to see interest rates or expectation of interest rates move higher, the duration is higher and you see more pressure. Also, we have to bear in mind that what we saw in January and February from southbound flows from investors in China into Hong Kong, annualized was by far the biggest we'd ever seen. So it's not a huge surprise to see some profit taking on winners. That's happening in the US, that's happening in China as well. But we advocate to own both. I think in the short term, A shares will probably continue to perform a little bit better, but longer term, we still like Hang Seng Tech and some of the growth prospects there. But that's a much longer term view.